Hey everyone, Tim Melvin here, and welcome to the new edition of the Hidden Profit Report. We're talking today, today's a treat, so you guys are really going to enjoy this. We're on with Wes Gray, one of my favorite people in all of investing in finance. Wes, just a little background, he's a Marine captain, was actually deployed to Iraq, correct?
Yep.
Um, Wes then came home, got an MBA from the University of Chicago, along with a Ph.D. Studied under the legendary Eugen Fama, one of the founders of modern portfolio theory, and just about everything else that has gone on in academic finance. Um, he then went on to become a finance professor at Drexel University. He's the author of one, two, three, four books. Embedded, which I assume is about his adventures in the Marine Corps. Quantitative Value with Tobias Carlyle, one of the better books that I've read in many, many years on value investing. DIY Financial Advisor, the title on that one's self-explanatory. And Quantitative Momentum, which is by far the best book I have ever read on momentum investing from an individual investor's point of view. Wes, thank you so much for taking some time out to talk to our readers today. Just kind of, part of the mission of making everybody a little bit better and smarter when it comes to investing their money. You're one of the best at that. So thanks for spending some time with us today.
Yeah, appreciate it, Tim. It's an honor to be here.
Yeah. Well, I don't know about all that. We'll talk in 30 minutes and see if you still feel it.
No, I appreciate anytime we get the opportunity to educate. It's all good.
Yeah. Now, Wes, when we first ran across each other, I mean, I'm a die-in-the-wool value investor type. Um, Straight back to the Ben Graham classroom, all the way up through Walter Schloss, price to book, price to free cash flow. And that was my gospel. And then I met you. And the concepts of momentum and trend were introduced. And that's something when the old school value guys, right? We were taught from birth pretty much that the momentum and the trend guys, they just had their head inserted somewhere and that was evil and bad stuff. Really not the case though, is it?
No, but that said, I'm like you. I was a die-in-the-wool value guy, still am. Read Ben Graham's book, know the whole story. I think what we miss is Ben Graham says, hey, buy with the margin of safety, buy cheap, all that good stuff. But he also mentions this thing called Mr. Market. And Mr. Market is manic, depressive, and insane. And so that is what he's basically pointing towards is momentum and trend strategies. So weirdly enough, as I've thought about this, I think Ben Graham was actually already highlighting that there's clearly the fundamental side, but there's also this speculative market side, and you should be able to go take advantage of that too. He just doesn't outline a strategy, but that's obviously, what momentum trend strategies are trying to do.
All right, well, let's break down the three legs, as it were, of the investing stool. So let's talk about value investing, how you approach value investing, what you think the important metrics are, because I know you, like me, you're very quantitative. So tell us about Wes Gray's approach to value investing.
Yep. So again, I'm just stealing from Ben Graham here, where he used to do a strategy that's like, hey, buy firms that got some semblance of quality and just go buy the cheap PE stocks. That basic idea of just buy cheap stocks that are out of favor. And then at the margin, if you can identify the ones that are higher quality, just hold your nose and buy those. So that's when we talk about value investing, that's what we're talking about. Just using the computer to get to the cheap dirt balls everyone hates, buy with the margin of safety, and hold your nose. That's my value investing, how practiced nowadays. I used to be a stockbreaker, but now it's systematic quant a la Ben Graham.
Okay. And you very rarely find yourself buying the stuff that people love.
No, exactly. So part of our algorithm is to essentially sort down after a bunch of other things to the 10% cheapest securities in the market. We use EBIT to TV, enterprise multiples, operating income. There's a million words for it, but just if your audience isn't familiar, just think, cheap earnings to price is the best way to explain it. So if you're obviously looking in the 10% cheapest stocks based on that, you're not exactly getting stocks that are the darlings like Tesla. You're getting, you know, the Exxons, the home builders, not now, but like, you know, a year or two ago, things that are just out of favor. And clearly there's a lot of hair on the narrative. Otherwise they wouldn't be in the 10% cheapest.
Right.
For sure.
What kind of stuff are you seeing today? Just broad sector.
Just broad. It's like what you would expect. Everything that's not Facebook and Tesla and all that fun stuff. So you're thinking energy, mining, you know, consumer, like boring consumer companies, things that aren't sexy is generally what's going to be in your cheap bucket.
Okay, now let's talk momentum, because for a lot of our audience, they're not familiar with the concept of momentum. You know, it's you hear
Sure.
about, you know, trading and buying stuff that's moving, but momentum can actually be a little bit more scientific than chart patterns, let's say.
Yes. So, and unfortunately, it's very important because the semantics that you could say momentum, it could mean 100 different things. And that's because academics essentially screwed it up. So really, when we talk about momentum, which is what academics labeled relative strength, that's what we're all talking about here is relative strength, core, that idea. And so relative strength strategies, which is kind of the old school way to explain momentum, is basically you got A and B. You just want to buy what is relatively stronger. So if A is down 20 and B is down 50, you buy A, right? If A is up 20, B's down 10, you buy A. It doesn't really care about the absolute trend. It's just what is relatively the strongest.
Mm-hmm.
Buy those, even if they're losing money. That's generally considered what they call momentum in academic research, and in practitioner land, relative strength. And we use it for stock selection. So just basically buy winners relative to the rest of the stocks in the market.
Okay, now do you place any type of valuation caps or volatility caps or anything to keep you from you know, owning stuff that's about to explode?
So no, and weirdly enough, you ruin momentum strategies. Like what I always tell people is whenever you're doing value, put on your Ben Graham hat and think through fundamentals.
Mm-hmm.
Whenever you're talking about momentum or trend, put on your Mr. Market speculative mania human being hat and think like that. And human beings don't think rationally or think about fundamentals. So actually, when you incorporate valuation or quality or any sort of traditional fundamental metric in a key or a core momentum strategy, it actually screws it up, makes it worse. And it makes it more correlated with what you're already doing. So with momentum, you just ride that wave. But it is very important that you also are able to get out of that wave if you need to. So it's a much faster, high turnover strategy. But if it's rocking, you know, you're knocking and you're buying that sucker. However, with momentum names, if they start losing their relative strength, you have to get rid of them. You don't want to hang on to them because now you're literally doing the opposite of momentum, which is low momentum. And so, yeah, fundamentals do not apply in the context of momentum strategies. You just screw them up by incorporating those in general.
Okay, now since we want to get out fairly quick, how often would we ideally rebalance a momentum strategy? Monthly, weekly?
Yeah. So yeah, monthly is generally how the academic research is done, and that's recommended. But of course, we always have to operate in a vacuum of
Right.
frictional costs and taxes and all this other fun stuff. So we generally do concentrated momentum portfolios at the quarterly mark.
Mhm.
We've gotten very good at trading, and we're getting more confidence where we might be able to move that to the monthly at some point in the future. And that's just because there's a trade-off, right? Like you definitely got to be at least quarterly for sure. And if you could get to monthly in a vacuum, that'd be ideal. But like I said, it's only ideal if you don't get eaten alive in the frictional costs and taxes of all that trading. But if you had like a qualified account or you could leverage ETFs or what have you, you can get rid of the tax problem, and then it's just a frictional cost decision. But faster is better with momentum. Where value, it's not the case. You can be slower and still capture a big chunk of the benefit.
So yeah, let's just say 30 stock portfolio. You're just going to
Mhm.
buy the best 30 stocks performing over the last year, I assume.
Yep.
And you're going to own those until they stop being in the top 30.
Yes. So literally the academic way that people have tested this going back 100 years, now other people have tested it go back even another 100 years. It is the most brain dead strategy of all time. Every month you go sort stocks on their past 12-month returns, and you take the top, in your case, you just mentioned, take the top 30 and repeat every month. That is like how the academics document the performance of that strategy. And obviously it's super volatile, bounces all over the place. However, the expected return on that strategy over like, multiple, years, 20, 30 horizons is generally, 50, 60% higher than just buy and hold S&P. But obviously it is a bucket Bronco.
You're going to work for it.
Yeah, you're going to earn it. But it is.
Stomachs need not apply.
Yes, exactly. But it is considered an anomaly because even though the volatility is substantially higher than just buying the market, the returns are so much more higher that's why professors consider it anomalous, because like on a risk adjusted basis, you seem to get too much return for even the increased risk. And that's why people like the strategy. But, it's clearly you want to size it correctly. Or have the horizon or the risk tolerance to deal with it, because it's not for everybody, for sure.
Okay. So this is where we might own the Nvidias and the Teslas and some of those names. Where
100%.
As a value guy, I saw something today by one of your guys, Ray Michelati.
Yeah.
In his weekly piece, he looked at Nvidia, and he said, "Okay, if Nvidia at 41 times sales to justify the valuation has to grow at 20% a year for 20 years." And all of the revenue has to go back to the shareholder in order to justify the current price to sales, which is terrifying.
Oh, it's crazy.
But then he went further. This is, I loved it. He's like, by that point in time, Nvidia is 50% of US GDP.
Yeah, just the math. Yeah, compounding math is surprising.
So on the value side, we might not love it, but on the momentum side, we're going to take the ride as long as it's in the top, whatever our X is for number of stocks.
Yes. And that's what, I had to learn this the hard way. All value investors do. You cannot take a value brain and apply any of that logic to momentum. It's literally a strategy. You just follow the model, do the system, and don't try to use your brain power, because it's just, it's basically, I like to think about it as like there's fear and greed in the market. Value is the fear trade, right? You're buying stuff that's ugly, nasty, and people hate. Momentum is the greed trade. And if you're a value investor and you believe in behavior, well, you probably believe in fear and greed. You need some tool to take advantage of greed. It's called shiny rock object strategy, better known as momentum. And you just got to hold your nose and buy it, because it'll help kind of smooth out your line over the time. But you're not going to like it. If you look at the names, you're going to vomit pretty much every time.
Yeah, it's almost like a couple drinks before you look at the screen helps a little bit.
Yes, exactly. I mean, a lot of times value names are like that too, but at least in your head, you're thinking, all right, margin of safety. You get value, like real value guys actually get turned on by nasty stuff, right? It's like,
I've been buying garbage all my life, right? I mean,
exactly. You're used to that.
My teeth on bankrupt utilities, so
exactly. So it actually turns you on to have a boarded up house and like 2x4s.
Absolutely. But there's a couple mob guys hanging around outside.
Exactly. You're loving that, and you just can't apply that logic or that brain power to momentum, because it's literally the opposite kind of ethos. But that's also, weirdly enough, why I think value investors, weirdly enough, benefit the most from it, because it's, helps them kind of buoy their ship when their strategy sucks. Usually momentum is generally doing okay. So it's good for, diversification and smoothing the ride out a little bit.
Right. And you've done some work on that. And Cliff Asness has done some very good work on the whole idea of pairing value and momentum strategies. Can you just touch on that a little bit?
Yeah, I mean, very simply, like we just mentioned, there are two religions and they yin and yang, right? So when your value religion is doing great, momentum is generally doing bad, and vice versa. And so if you believe in diversification, or you care about how smooth your line moves along over the years, it makes sense. If you have two things that are pretty different, if you pull them together, you kind of get the same return, but with slightly less volatility. And that's essentially the essence of what everyone talks about with combining value and momentum.
Okay. All right, now we got one more religion left. That's trend. That's
Yep.
trend following. Which, look, if you grew up a value guy in the '80s, and I did because I'm really old,
Yeah.
you know, then your competitor, everybody was talking about Richard Dennis
Yeah, sure.
and
The turtles.
the Turtles,
Yep.
and it was your honor and your duty to debunk that it was possible, it was a one-off, it could never happen. But then when you look at it, they were just trend following, and it seems the trend following does work.
Yes. So first definition of what the heck do we mean by trend following, at least how we do it. Like we talked about, momentum is looking at relative strength. So how does this thing look relative to other stuff? Trend is a lot of times just looking at that single asset. And is this thing positive trending or negative trending? If it's positive trending, we're buying. If it's not, we're out. It's that simple. So that's what trend following is, just to make sure everyone's talking about the same thing, which I know you are, but just to make that
Right.
clear.
Yeah.
And yes, that is another strategy where, again, I'm religion, value, and then I got introduced to that probably 15 years ago by this huge family office that put us in business. And, I was coming out of Eugen Fama, University of Chicago. Right. If you even mention momentum or trend, you're going to get stabbed in the face. And so it took me a long time to kind of like fight the status quo, to be like, holy cow, I mean, this is a legit thing, and I need to actually be serious about considering it. And, now it only took 15 years, but now I'm a total buyer. And what I always tell people is trend is not going to make you rich. It's going to keep you from being poor, right? It's a risk management strategy, where value, momentum are more about like, how do I compound? How to get rich. Trend following is more about risk managing and not losing your ass. But you're not exactly going to like, they're usually not designed to get rich. It's not going to like make you have extra return per se. But I like it. It's a great tool for risk management.
Okay, very good. Now look, let's move along here, because you're up to something new as always, and you just came out with something that I find absolutely intriguing, and it's your box ETF, and I think that's BOXX. Is that correct symbol? I think.
Yep, that's the symbol.
And let's talk about the strategy here, because this is pretty cool, and it's T-bills plus in a time where T-bills have, for the first time in since some people have been in our business,
actually make money.
Yield, you're actually able to better that consistently, and I think the way I've read the literature on it, it also delivered higher than T-bill returns when T-bill returns were really garbage. So tell us about what you're doing with this strategy.
Yeah. So unfortunately, this is somewhat complex because it has to do with options, but we're going to try to, what they call in the Marine Corps, Barney style, like the old purple dinosaur. We're going to Barney style this as simple as possible. So a box spread is basically you're going to use 4 options. Okay. And you're going to use 2 of those options to replicate a long position in the stock. That would, like, let's say you're doing like SP 500, usually use this thing called SPX, right? So 2 of the options will replicate a long position. Specifically, that's going to be a long a call, short a put. And then 2 of the option positions will replicate a short position in the stock. That's going to be long a put, short a call. Now, intuitively, even if you don't know anything about options, if I replicate a long position in a stock and I replicate a short position in a stock, we don't have market risk, right? Like if I'm long and short the asset, I've eliminated market risk movements. And so implicitly, that's what a box spread is doing in this strategy. You're literally crossing out all market risk. And what you're left with is the embedded funding rates that are in option markets. And so what that means is if you buy a box, it may deliver, say, $1,000 3 months from now. And anytime you have a trade that functionally will guarantee $1,000 delivery 3 months from now, well, it's not going to sell 0. It's probably going to sell at like, 980 or something, right? And then you'll earn like that little premium. That's your interest, right? So it operates functionally just like a treasury bill if you buy a box. And you can also sell a box. That'd be equivalent to essentially selling a treasury bill. And so long story short, that's what the box spread does in general. It's a way to replicate T-bill returns and risk through the option markets. And it's a huge pain in the ass, and it's way more complex than just buying a T-bill. So people got to ask, like, well, that's great, Mr. PhD. Why'd you add all this complexity and do all this bullshit to just deliver a T-bill return? That's a damn good question. And there's really kind of two answers to that. The first answer, and you know, God only knows what the future holds, and it's a whole discussion about why this is probably the case. But in general and historically, not just us, but like academics and everyone has shown that historically, box spreads earn T-bill plus anywhere from like 25 to 50 basis points, right? And there's a lot of reasons and arguments of why that is. All I can tell you is that historically, ever since they've looked at it since the 80s, that's generally what you get. What does that mean? That means if the T-bill is giving you 5% annualized, you know, on a box spread, it's going to be anywhere, you know, pre-cost and pre-frictional execution, you know, maybe it's at 525 to 550. So that's benefit one, is there's this spread over T-bills. The other, well, and let me address another question. Well, as good Fama student, you always want to ask, well, okay, if something earns higher return, it has to have higher risk. Well, this is a weird scenario where that's arguably not true, because the risk in a box spread, if you're using European options, which are options that they only expire at the end, the only risk you have in a box spread is the counterparty. And the counterparty is the Option Clearing Corporation, which has the same rating from Standard & Poor's as the U.S. government, and it's a SIFMU, so it's backed by the Fed. So whatever you think the risk of a T-bill is, I would argue the OCC has the same risk, because it is the government basically, right? So it's one of these unique trades where you actually can earn a little bit higher return, and arguably the risk is the same. And there's functional reasons of why that spread exists that's kind of complicated. But that's reason number one. The second reason, let's just pretend the excess return goes to zero, which I always tell people, and we got to be careful about the details here, but there's a lot of tax implications and potential benefits of owning box spreads versus treasury bills. And that's another big reason why, you know, we find them kind of interesting. Because as you know, like behind the scenes, most of our business is related to tax efficiency. So
sure,
the excess return is cool, but that's not really what we're in it for in the end.
Right. Now, tax efficiency kind of legs me into the next kind of segment of this, and that's white label ETFs, helping advisors and family offices and other folks start ETFs. And there's some big reasons here, not the least of which is taxes. So let's talk about why ETFs.
Sure. So yeah, as you mentioned, I used to try to find alpha. I still do, but that's hard. But figuring out how to avoid or minimize taxes can add a lot of value real quick. So we focus on that. And ETFs in particular basically get a cheat legally. So if I'll give you a simple example, and this is way oversimplified to make the point, this is not realistic, but it highlights the mechanisms of an ETF versus every other way you invest your money. So let's say you have a taxable dollar and you go buy Microsoft for $1, goes to $100. And you're like, all right, I want to trade out of Microsoft and go buy Exxon. If you do that in your personal account, what's going to happen? Well, you're going to sell Microsoft, have a $99 capital gain, go use the cash and go buy Exxon, but you got to pay the tax. Mutual fund, same thing. You're going to have to pay the tax. Hedge fund, you're going to have to pay the tax. Everything you're going to have to pay the tax except an ETF potentially. Now, if you were to actually sell Microsoft in your ETF directly, it would be just like every other wrapper. You're going to have to pay the tax, the $99 distribution. But ETFs have this unique mechanism where they don't buy and sell securities in the fund. They trade them through baskets. So the way an ETF would deal with that transaction we just mentioned there is I would take the $100 of Microsoft, stuff it into what they call a custom redemption basket, And then I would simultaneously create what they call a custom creation basket of equal value of cash, let's say, right?
Mm-hmm.
Tomorrow, what would happen is the fund would kick out the Microsoft shares, not sell them, redeem them out. That's a non-taxable transaction. And then I would create in also non-taxable transaction, $100 of cash. Then I go buy Exxon, fund has a basis of $100, we move on. So ETFs, like I said, because of custom create redemption and these basket mechanisms, we essentially, it's like a laundromat for capital gains, which is awesome, right? It's legal. It's some senator a couple years ago called it the great ETF tax swindle. And I'm not going to argue. It's not, I don't make the rules. I just follow them.
Right.
But I'm not the congressman, senator, God bless them. I'd never want to do that. But, that's the rules. And so that's what we use. And ETFs are basically a massive scale tax deferral scheme in plain sight. And so that rolls back to, well, that makes a lot of sense. If everyone could manage their money in an ETF, why wouldn't they do that? Right.
Right.
It would be. And so then it was on us to figure out, well, how do we create a service offering where we rip out the cost such that more people can participate in the ETF market? You don't have to be Vanguard and have $1 billion fund to have this make sense. Maybe if we get the cost low enough, you got, say, $25-50 million, or you can rally up your buddies, you can launch an ETF and take advantage of the tax benefit. So that's what we're doing over there. And we're just trying to open up the marketplace where not just $1 billion asset managers can participate, but anyone who has a decent amount of capital can potentially take advantage of the ETF tax benefits.
Okay. All right. Now, you also, there at Alpha Architect, you have some ETFs that are offered to the public with all the cool tax advantages, but also just using some proven quantitative strategies. You just want to just kind of quickly run us through what the various offerings are?
Yeah. So we have two, like we just talked at the beginning there, two value funds that they're kind of like old school Ben Graham, right? I'm not going to overcomplicate it. We're just trying to buy the cheapest stocks in the market, and we're buying the top 50 cheapest with quality. It's that simple in the end. Like, there's a lot of complexity, but we're just trying to go for that old school deep value investment risk premium, which has obviously sucked the last 10 years, but I'm still a believer. I still like Ben Graham, so I still put my own money in it. Obviously, a lot of people think value is stupid, but that's what that does.
Right.
And then on the flip side of that, we have several funds that does the opposite, concentrated 50 stock momentum, right? We're just buying the 50 most maniacal, moving stocks in the market. And that's what we do, right? And obviously, like, the weeds are a little bit more complex, but at the core, it's very simple. Buy the cheapest stocks. We got two funds to do that. Buy the highest momentum stocks. We got two funds to do that. And then how people want to use them is up to them.
Okay. And you've also helped some folks start some pretty cool ETFs. Can you just touch on a couple of those? Or?
Oh, yeah. We've got, I think we've launched 40 funds at this point.
Yeah.
Lots of cool ones. Just off the top of my head, like the most unique. So, like Per Toll launched like a freedom-based ETF in emerging markets, which is really cool. It just says, hey, I don't want to invest in countries with like Putin or communist rule.
Right.
Like, let's own ones that are like kind of democratic, believe in human rights. Well, hey, no shit, those work better. And obviously we've seen that in real time.
Right.
And she's, she started at 5 mil. Now she's got, 700 mil. So she's done really well. As you mentioned, Ray Micheletti's got a cool fund. It's, relative sentiment. So, most people use trend following to try to time the market, which I do as well. His idea is that, well, let's follow the smart money and look at like how are smart investors, i.e. institutions, positioned against retail. And whenever you see a stretch in that, where the smart money's like buy, and the retail is like sell, hey, we should actually buy equities, right? Like, and so he's got all these fancy algorithms. He's got a PhD and all that good stuff. That's a really cool, unique fund. Maybe one last one for you would be, I guess, Kai Wu. He's a super entrepreneur as well. It's called Intangible Value. And it's kind of like poo-pooing on everything I do. That's why I'll mention it. But his basic idea is like, oh, you value fuddy-duddy deep value guys. You just buy garbage and hope someone else will pay more for your garbage in the future. And that's an okay strategy, but that's not value. And he's like, it's all about intangible value, right? So what his algorithm's doing, what he's kind of come up with is like, instead of valuing based on like earnings to price, let's value companies on like patents to price, PhDs to price, intellectual property to price. And a lot of people talk about that, but he actually does the real research to identify that. Yeah, it's really cool. It's called intangible value. I think ticker's ITAN. It's just, it's also like a very unique fund that is just different, right? It's not momentum. Right. It's not value. It's like deep dive intangible value research. I don't know how it's done, but just his process and his intellectual heft behind it, I just find kind of interesting. So those are just a few examples of kind of the smaller, more boutique-y funds we've launched.
Okay. First, I want to say, just thanks for the time. We've taken 30 minutes out of your day, and you've got better things to do in the business world, and certainly being in Puerto Rico.
I don't know about that.
Well, okay. Well, but let's get a plug in for your favorite event, and one I keep threatening to come to, and every year I get right up to the point of booking the plane and realize, no, I'm not doing that. That's the March for the Fallen. Tell us about that.
Yep. So March for the Fallen, something we've been doing 8-9 years in a row. And it's pretty easy. You're marching for the fallen. And what it is, it's direct consumer charity where we're just trying to let Gold Star family members, those that had someone die in combat, just let them know that we recognize their sacrifice, right? And you do that by showing up out in the middle of nowhere in Harrisburg, Pennsylvania. We do a 28-mile ruck march. If you're old or busted or whatever, you can do 14-mile, you can do 5K. Doesn't really matter. It's not about the distance. It's about personal summits. And that'll be September 23rd. We fund the lodging and the chow if you come through our group. And I think it's like $40 for the event or something. So if you want to do it, just alphaarchitect.com/MFTF, click register, and we'll march with you out there.
Yep. And alphaarchitect.com, Wes just mentioned it. It's one of my go-to research sites. And they send an email out every week telling us what they've updated and talked about on the blog. And it's some of the more cutting edge research in all of finance today. And, normal people can read, I'm going to say 90% of it. So
you
every
got
once in a while they get wonky, but
Yeah. Sometimes they get wonky, but I have Elizabeth and Tommy, both former educators and PhDs. And then Larry Swedrow, who you probably know, he's written more books than anyone alive.
There's 2 of them around here somewhere.
Yeah, their mission is, hey, keep on the research, but let's write these summaries so normal people can understand like what's the high level point of this research without having to do math equations. And so that's what we're trying to do, just trying to make the academic research more accessible to normal people, basically.
Okay. Well, as you can see, my contractors are currently tearing down large parts. That's going to be a super exciting afternoon on that front. But all right, Wes, thank you so much. 34 minutes out of your day. I know it's a lot to ask, but thanks for spending some time with us and educating our readers on some of the more innovative things going on in finance today.
Yeah, appreciate it. Like I said, honored to be here and look forward to doing it again in the future.
All right.